Hello everyone, welcome to our channel Sheerexperience. In this video, we are going to solve a depreciation problem. That is when there is a change in the depreciation method and also with the retrospective effect. Now let's see the problem. ABC Limited purchased on 1st January 1998 a second-hand plant for Rs 30,000 and immediately spent Rs 20,000 in overhauling it. On 1st July 1998, additional machinery of a cost of Rs 25,000 was purchased. On 1st July 2000, the plant purchased on 1st January 1998 became obsolete and was sold for Rs 10,000. On that date, new machinery was purchased at cost of Rs 60,000. Depreciation was provided at 10% per annum on the original cost of the asset. In 2001, the company changed this method of providing depreciation to 15% per annum and written down value method with retrospective effect. Show plant and machinery account and provision for depreciation account for the years 1998 to 2001. In the problem, we are asked to prepare plant and machinery account and provision for depreciation account. So, when provision for depreciation account is maintained, then depreciation is charged to provision for depreciation account, not to plant and machinery account. This point we should always keep in mind. First, we will do the workings and then prepare plant and machinery account and provision for depreciation account. I have mentioned purchase date of the machine, cost of the machine, sale date of the machine and sale value for the easy reference, so that we don't have to go back to the problem and check for these details. Here we have two methods. The first method is original cost method, which is also called straight line method, and the rate of depreciation is 10% per annum for straight line method. And second method is written down value method. For this method, the rate of depreciation is 15% per annum. We have 3 machines. Out of 3, 1 machine has been sold. So first we will calculate loss or gain on the sold machine. Machine 1 was sold on 1st July 2000 for 10,000. The cost of the asset is 30,000. But we have spent 20,000 immediately for overhauling. You can consider overhauling as repairs. So the total cost of the machine is 30,000 plus 20,000, that comes to 50,000. To arrive at the book value of the machine, we need to deduct the total depreciation from the cost of the machine. Depreciation for first year, that is for 1998, cost of the machine is 50,000 and rate of depreciation is 10% per annum. Depreciation amount is 5,000. And for the second year, that is for 1999, it is again 5,000 because we are following straight line method. Since the first machine was purchased on 1st January, we are considering the calendar year, that is from January to December, to calculate the depreciation. We have sold the machine in the third year, that is on 1st July. So the depreciation is calculated only for the first 6 months, that is from January to June. The depreciation for 6 months is 2,500. A total depreciation on machine 1 is 5,000 plus 5,000 plus 2,500, which comes to 12,500. This is the total depreciation for machine 1. Now we need to find out the book value of machine 1. We all know that book value is equal to the cost of the asset minus total depreciation till date. That is 50,000 minus 12,500, which comes to 37,500. So this is the book value. Sale value is given as 10,000. Loss or gain is equal to sale value minus book value. That is 10,000 minus 37,500, which comes to 27,500, which is in minus. So this is a loss. In the question, there is a change in the depreciation method from 2001 and also with the retrospective effect. Since we have sold machine 1 on 1st July 2000, we don't have to consider this machine for calculating excess or short depreciation. Excess or short depreciation is calculated only when there is a retrospective effect. Method of depreciation can be changed with or without retrospective effect. Without retrospective means no adjustments are made for past year entries. We just have to change the depreciation method and continue to charge the depreciation based on the changed method. Retrospective means we need to adjust the depreciation amount according to the new method from the purchase date of the asset. Here we are solving the problem with retrospective effect. So we need to adjust the depreciation amount as per the new method, that is WDV method, which is nothing but written down value method. That is also applicable from 2001. Now we have only two missions, that is mission 2 and mission 3. We will calculate excess or short depreciation for mission 2 and mission 3. Always remember, while calculating excess or short depreciation, first we will calculate depreciation based on the old method or first method. First method was straight line method and the rate of depreciation was 10% per annum. Here we have only two missions, that is mission 2 and mission 3. Cost of the mission 2 is 25,000 and mission 3 is 60,000. Depreciation on mission 2 for the year 1998 is 25,000 into 10 by 100 into 6 by 12. Here we are calculating depreciation for 6 months because the purchase date of the mission 2 is 1st July 1998. So the depreciation amount for mission 2 for year 1998 is 1250. Depreciation for the year 1999 is 2500. Here we are calculating the depreciation for whole year. Similarly, depreciation for year 2000 is 2500. Mission 3 was purchased on 1st July 2000 for 60,000. So depreciation for the first year is 60,000 into 10 by 100 into 6 by 12, which comes to 3,000. Here also we are calculating depreciation for 6 months because the mission 3 was purchased in the month of July. Now we will total the depreciation amounts for mission 2 and mission 3. Mission 2 total is 6,250 and mission 3 total is 3,000. Till here we have calculated depreciation for mission 2 and mission 3 using first method, that is straight line method. Now we will calculate depreciation on mission 2 and mission 3 using second method, that is WDV method, which is nothing but written down value method, and the rate of the depreciation is 15% per annum. Cost of mission 2 is 25,000 and mission 3 is 60,000. Depreciation for first year, that is for 1998 on mission 2 is 25,000 into 15 by 100 into 6 by 12, which comes to 1,875. Here we are calculating depreciation only for 6 months because the mission 2 was purchased on 1st July 1998. Since we are using WDV method, that is written down value method, we need to deduct the depreciation amount from the cost of the mission. Cost of the mission is 25,000 and the depreciation amount for the first year is 1,875. So 25,000 minus 1,875 comes to 23,125. So this is our reduced value of the mission 2 in second year. On this we will calculate depreciation amount. So for the year 1999, depreciation amount is 3,469. Similarly, for the third year, we will deduct the second year depreciation amount from the reduced value, that is 23,125 minus 3,469, which comes to 19,656. On this we will calculate 15%. Which comes to 2,948. This is the depreciation amount for the year 2000 on mission 2. Here I have rounded off the depreciation values. I am not taking the decimal points. Now we will calculate depreciation amount for Mission 3. Mission 3 was purchased in July 2000. We will calculate depreciation for only 6 months. Cost of the mission is 60,000 and rate of the depreciation is 15%. Depreciation amount comes to 4,500. Now we will total the depreciation amounts for Mission 2 and Mission 3. Mission 2 total is 8,292 and Mission 3 total is 4,500. To get the adjusted depreciation amount, we need to deduct the first method total depreciation amount from second method total depreciation amount. That is, second method total depreciation minus first method total depreciation amount. For Mission 2, second method total depreciation amount is 8,292 and first method total depreciation amount is 6,250. So, 8,292 minus 6,250 comes to 2,042. For Mission 3, it is 4,500 minus 3,000, which comes to 1,500. Now we will add these two amounts, that is 2,042 plus 1,500, which comes to 3,542. This is our adjusted depreciation amount. Now we will prepare plant and machinery account. On 1st January 1998, we have purchased Mission 1 for 30,000. Immediately we have spent 20,000 on overhauling. We will record these two amounts on the debit side and mention to bank in the particulars column. In the same year, we have purchased Mission 2 for 25,000. And we will mention to bank in the particulars column and 25,000 in the amount column. We did not purchase or sell any other missions in this year. Since we are maintaining provision for depreciation account, we are not charging any depreciation in the plant and machinery account. Now we will balance on both the sides. Total is 75,000. We will mention this on both the sides. On the credit side, we mention date as 31st December and in the particulars column by balance carried down. And we will mention Mission 1 and Mission 2 amounts. Here I have added the overhauling charges to the cost of asset for Mission 1. So Mission 1 value is 50,000 and Mission 2 value is 25,000. We have made a separate video on ledger rules and for depreciation journal entries. I will leave the link in the description box. If you guys want, you can watch it. We will bring down the same balances to the beginning of the next year. In the second year, we did not purchase or sell any missions. So we will do the balancing like however we did it for first year. In the beginning of the third year, that is in 2000, we will bring down the same balances for Mission 1 and Mission 2. In this year, on July 1st, we have sold Mission 1 for 10,000. So we will mention by bank account in the particulars column on the credit side and 10,000 in the amount column. We have already calculated loss or gain on Mission 1. We will record this in the credit side as by profit and loss account and amount is 27,500. During the time of the sale, we need to transfer the accumulated depreciation amount for Mission 1 to the asset account. If the asset is not sold, then we don't have to record this in the asset account. Here, the accumulated depreciation amount for Mission 1 is 12,500 and we'll mention by provision for depreciation account in the particulars column on the credit side. In this year, we have purchased a new mission for 60,000. The purchase date is July 1st and we'll mention to bank account in the particulars column and 60,000 in the amount column. Now we will balance the amounts on both the sides. As usual, we will bring down the balances to the beginning of the next year, that is 2001. In this year also we did not purchase or sell any mission. So we will balance the amounts on both the sides. Now we will prepare provision for depreciation account. For first 3 years we will charge depreciation using straight line method. So as usual at the end of the year, that is on the December 31st, 1998, the depreciation amount for mission 1 and mission 2 is 5,000 and 1,250. We mentioned by depreciation account in the particulars column on the credit side. Now we will balance the amounts. We will bring down the same amounts to the beginning of the next year, that is January 1st, 1999. As usual at the end of the year we charge depreciation on mission 1 and mission 2. We will balance the amounts on both the sides. The same balances we will bring down to the beginning of the next year, that is January 1st, 2000. As usual, we will charge the depreciation at the end of the year. In this year, we have sold mission 1, that is on July 1st, 2000. So we calculate depreciation only for 6 months. So the depreciation amount is 2,500 for mission 1. For mission 2, depreciation amount is 2,500. In this year, we have purchased a new mission for 60,000. So the depreciation amount on mission 3 is 3,000. This is calculated only for 6 months. As you remember, during the sale of asset, we transfer accumulated depreciation amount to the asset account. Here we have sold the first mission on July 1st, 2000. The accumulated depreciation amount for mission 1 is 12,500. This amount we will mention on the debit side as to plant and machinery account and 12,500 in the amount column. Now we will balance the amounts on both the sides. We will bring down the balances to the beginning of the next year, that is January 1st, 2001. Since the change in depreciation method is from 2001, we will mention the adjusted depreciation amount on the credit side as by depreciation account, and the adjusted amount is 3,542. Now we have to mention the depreciation amount for mission 2 and mission 3 using written down value method. Our reduced mission values for mission 2 and mission 3 are 16,708 and 55,500. 15% on these two amounts are 2,506 and 8,325. Now we will balance on both the sides. Highest amount is on the credit side, that is 23,623. We will carry down the amounts for mission 2 and mission 3 on the debit side. For mission 2 it is 10,798, that is 6,250 plus 2,506 plus 2,042. This 2,042 is the adjusted depreciation amount. For mission 3, amount is 12,825, that is 3,000 plus 8,325 plus 1,500. Here also 1,500 is the adjusted depreciation amount. Hope you guys have understood the explanation. If you guys have any questions related to this problem, please post in the comment section below. And if you guys like my explanation or if you understood the problem, do not forget to click on the subscribe button. Thanks a lot for watching this video.